Hi, welcome back to Academic Market Insights. I'm Professor Russell Rhodes at the Kelley School of Business, and I am joined, as always, by Dr. Larissa Demiak up at Purdue University. She's a little bit north of us. The big hope here is we get a natty in football for IU and we get a natty in basketball for Purdue, and Notre Dame gets nothing and likes it.
Oh.
So with that, I don't know why I brought that one up, but with that, we're going to spend a few of these videos talking about what I refer to as market volatility events, and I think that's because of my VIX background, but market crashes or market mishaps, etc. And the first one's a really fun one because it's got a couple of guys that did straddle the academic and professional area, like Dr. Ademiak and I, long-term capital management. Dr. A has done some digging. How many times have you read the book?
Oh, I don't know, a handful. I,
Yeah.
I think I bought it a couple of times. I've given it away a couple of times. There's
It,
a pretty famous book called When Genius Fails that discusses this particular catastrophe, maybe is a good word to describe it. But it's unique because it's really juicy.
yeah.
Like got
Yeah.
drama. So you talk about market crash, volatility event. It's drama unfolding. And wouldn't it be amazing to have a film on this?
Yeah. It's kind
Right.
of shocking there isn't, but you know, I- we kicked that around a little bit, and it sort of occurred to me that the long-term capital management situation was more market specific. It didn't ripple through the economy like the 2008 thing, and we probably have referred to The Big Short in 20% of the videos that we've done, or other movies like that. But it may just be that it's such a niche that yeah, or
I
it's so hard to explain, which it is kind of a difficult thing to explain. The housing thing's pretty straightforward.
well,
Uh,
I was going to say that, but the long-term capital management, one of the things I don't think people realize is they had one of those secret meetings Sunday night where the Fed got people together, different hedge funds, different banks, and we're like, we have to bail these guys out.
yeah,
Otherwise, we all go down. So contagion, this is back in 98, was a real thing even then. So there were a lot of major players.
yeah.
From what I remember about the meeting, some people didn't want to participate and
And
said,
that caught up with them in the long run, and we'll hit on that. We'll hit on
oh,
that. I love
definitely.
that part.
And
Um,
so getting with some of the juicy players, if correct me if I'm wrong here, but I believe it came from Salomon Brothers. They were all fixed income traders, and they were called Merry Men because they all worked on John Merriweather's desk.
mhm.
And so they came over. They were these are the same guys from Liar's Poker, right?
Same desk.
Yeah, same
Yeah,
desk.
same desk.
It's a lot of the
Yeah.
same players. Do you mind, and I'm putting you on the spot, do you explaining what Liar's Poker is, the actual game?
Oh, Liar's Poker. Darn it. I just put away all of my hundos. But no, Liar's Poker is where in poker, a big part of poker playing is bluffing. And if you're ever playing poker with people that are traders, they like to bluff more than average. Keep that in the back of your mind. But what you do is you take the serial, your hand that you're dealt is the serial number on your dollar or whatever note you're using at the time. And if I've got three sevens, I might say four sevens. And if you call, if you say I'm bluffing, you've got me. So you try to figure out who's got the best hand without bluffing. I know that I'm missing a part of it, and there are probably a couple of people that have played it a million times on the floor that are going, "Man, he's butchering that description." But that's basically what it is. It's like a poker-like bluffing game that you use the serial number on bills.
Mhm.
And when I worked on the floor of CME back in the 90s, people would play every once in a while. And if you got like a dollar bill that had eight eights in, or like five eights or something like that, you would hang on to that sucker and you would
Just for the
use
game.
it. Yeah. And if somebody, and it was funny if somebody came across one, I actually moved to Atlanta and still had some friends on the floor. And if I came across a really good one, I'd hang on to it and give it to them when I came up here to visit. I was more about helping my buddies out than actually playing it. But that was a big, yeah, and that's why they called it Liar's Poker. That was just a big game that the guys played on the desk during downtime back in the day when they were making and fixed income
Money.
traders making, money left and right, hand over fist.
Well, and
There.
so this cast of characters that we're going to discuss, John Merriweather was the ringleader, and he did something really unique at the time, and he brought in some Nobel Prize winners.
Mhm.
So we're going to talk about these guys, and you can imagine just the drama that unfolded as they, and we don't have this graph in the presentation, but these gentlemen, I think it's 400% returns. So these
Mhm.
guys are making substantial amounts of money, and they're all living in Connecticut in this little area, driving incredibly posh cars, coming into the city, doing whatever they want. I appreciated at the end of the book by Roger Lowenstein that he talks about how as all the investors' money is falling apart, none of the guys in the fund actually had to sell their cars. They didn't have to move. So
Yeah,
the trader was hurt in the telling of the story.
there's nothing like other people's money, is there?
I found that a little comical because,
Mhm.
and I think that's one of the reasons why this is such an important story to tell is because this really started the idea of what does contagion look like?
Mhm.
And
Yeah.
the idea that there's no responsibility. So with that, and now we're going to look at the presentation. So
There we go.
exciting. So long-term capital market. Let's see the next slide. So
So what was going on at the
I,
time? We hadn't talked about the Russians yet,
we
but there
haven't.
was Russian stuff going on.
So well,
So
one of the things that and this isn't in the deck, but I think that this is important to comment on.
yeah.
He had previously mentioned they had banner record years of 400% returns. People were desperate to get into the fund. They wanted to be a part of this fund because they
Hmm.
were just investors were making so much money. The managers themselves were making money, the investors were making money. It's all good. The problem with scalability and size is it's a lot easier to go from $100 to $1,000 than $1,000 and to $1 million or $1 million to billion.
Hmm.
Once you start to get some of these much larger numbers, it's harder to get that same rate of return. So
Oh,
for
absolutely. And
so
I'm stepping on you here,
yeah,
but
yeah, yeah, no,
I
please.
I, I almost always I worked at a handful of hedge funds, and there was one I was interviewing at, and I asked the guy, it was kind of a relatively small startup one, and I said, how much do you think you can scale this? And he said unlimited, and I didn't go work there because
No,
that's not true.
it's not true.
And it's actually why most hedge funds have their best performance in the first 5 years, because the ones that have really good performance in the first 5 years attract a lot of capital. If they attract a lot of capital, it becomes much more difficult for them to implement whatever strategy they were doing well with. So yeah, it's there is a limit as to how much liquidity is available for you to implement your strategy, especially when people start copying it. So I know I just stole from you.
Yes.
Yeah.
Well, and so they were in a situation where they had several years that were just record years, and now they're trying to generate those same returns. And they were looking at different trades and they were using leverage to get into these trades. But one of the areas that they were very interested in was Russia.
Mhm.
And this became a big part of what helped unwind them. But at the time, Russia, this is mid 90s, most of their currency was valued or linked very much to the cost of oil.
Mhm.
And so we had a substantial growing of just prosperity in Russia. And this is also, you know, I think 95, 96. because long-term capital management came in 98, but the
Hmm.
wall came down in 89.
Hmm.
So we have the first part of the 1990s as a unique opportunity of prosperity, and things are just doing very well. So we see inflation falling. We see recovery in the economy. We see that we've got a relative high. Do you like that? Oil was selling at a relative
Relative high.
high of $23 a barrel. So things were looking very good for Russia. Let's see the next slide. So things are looking good,
Yep.
except for we still have some challenges, right? And
Hmm.
this is one of the challenges of investing in emerging nations in general. So we like investing in emerging nations because you've got usually higher rates of return. When you start to invest in those, because of the way FX parity or interest rate parity works, you're going to see a bump in hopefully, what is it? Bump in those interest rates as well. So you're
Hmm.
that return. You're also getting a higher rate of return on the actual currency itself. So you're seeing a lot of possibly good things, except for if the economy starts to unravel. And again, we're mid to late 90s. We're still less than a decade away from communism. So we still had a substantial amount of the workforce not working. They're not producing. There's the economy is not living up to its full potential. And part of that is just because of the way switching from communism to capitalism is going to take place.
Hmm.
So we have long-term capital management coming in because they want to see those excess returns because they're desperate to find excess returns. So they start investing in the Russian ruble. Now we're seeing towards the end, and we start to see oil prices drop, which makes the entire economy start to weaken because
Yeah.
it's so dependent on that price of oil. So we've got lots of, possibly good things, which is one of the reasons why long-term capital management got into it. And then
Hmm.
we can start to see the economy start to really break apart.
So there are guys.
There are
Hi,
our guys.
guys.
So, Dr. Rowe, I'll put you on the spot. Who
Hmm.
are Dr. Scholes and Dr. Merton?
They won a Nobel Prize.
What did they win a Nobel Prize for?
The Black-Scholes model. What
And
happened to,
what?
what happened to Black?
Oh, he died.
Yeah, but they did give him a special mention. You cannot posthumously win a Nobel Prize. How many people have posthumously been awarded the Nobel Prize? Nope.
Oh, someday four.
These are old guys.
Oh, okay.
And they announce it and then they award it. And apparently, four people didn't make it to the
Oh no.
ceremony.
Like,
I don't know which ones. I don't know if that's a made up stat, but
okay.
and I don't think it's in the econ. I think it goes way back to, 30,
Sure.
40, 50 years ago. But they tended to, I think a lot of Nobels are awarded as like, career awards.
Right.
And I think these two guys kind of got one as a career award because it was, yeah, they were awarded it while they were at Long-Term Capital.
Which
They
is
didn't get
pretty
it till the late 90s. The Black-Scholes model is from 73. And
73.
Merton was the guy that kind of confirmed the Black-Scholes model. That's why he was awarded it along with Fisher Black, or not Fisher Black, who just got a little mention, and
Yeah.
Myron Scholes. I always think about Breaking Bad because, he got a plaque that said contributed to Nobel Prize in Chemistry. That's how smart he was, but not smart enough in the business sense, I guess. So, but those are these two guys were a couple of the principals at Long-Term Capital. They were, let's just say, academic heavyweights that moved over into the money management space. And what they were, and really what their strategy was leveraging themselves up and going long something they felt was, maybe a bit underpriced and short things that were overpriced. And the Russia thing was the underpriced thing that caught up with them.
Did catch up with them. So I have a couple questions for our number one
Oh
fan.
my gosh. Okay.
Number one fan would like to know.
Hmm.
We talked about the Scholes-Merton model. What does it model?
Oh, option pricing.
Option
Yeah.
pricing.
Black-Scholes model is option pricing. We've got a very close friend that got the whole model tattooed on their back. I'm not going to say their name, but you know who he is.
I do
Yeah.
know.
That's how important it is to the option industry.
It's how important it is.
Yep.
And then you talked about leverage. How do you get leverage?
You borrow a little bit of money from big old investment bank. They give you, they maybe charge you a little bit above the risk-free rate because they think you're a good risk. And they basically they're housing their positions as well. So it's all part of it. It's much like the margin situation if I've got a futures account.
Or
I'm, you know,
or really if you're borrowing money and you're
mhm.
getting that extra capital and then you could go ahead and invest. So you're investing somebody else's
you
money,
know, if I can borrow money at 4% and I'm guaranteed to make five, or I think I'm guaranteed to make five, I'm going to do that as much as I possibly can. But the borrowing at 4%, eventually, if I borrow too much, they're going to start to charge me a bit more. And if I'm, buying into that guaranteed 5%, over and over and over again, eventually they're going to take a look at that side of it as well. So, the other people's money thing, there is a risk in there, and there's a big risk because, and I believe were they 100 to 1 levered or something ridiculous? I mean,
it was. I want to
it
say that
was it
that
was
was
a
100.
really high amount of leverage, and because they were equal long and short, I think the creditors or the banks that extended this to them were pretty comfortable with it just based on the previous 3 or 4 years performance before what happened, which you're going to talk about now.
Well, but I want to make a couple comments on that.
Uh-huh.
One of the things that I thought was interesting with the Madoff case, Bernie
Hmm.
Madoff said people had the opportunity to leave my fund anytime. They were greedy and stayed in and wanted
Yeah.
to continue. And so I think, there were these banks that were lending them, but they were also investors.
Yeah. Yeah.
So they
And
did not want to peek behind the curtain. And
yeah.
we're also talking about like a long short fund, which you and I understand, but those were popular or brand new popular hedge fund
Yeah.
strategies in the late 90s. These weren't things that people were regular doing. They
Right.
were new, they were shiny, they were exciting, and they were generating returns.
Oh yeah, yeah. I was at one of the Caldwell and Orkin. We had some really good performance, but we were an early long short fund, and we were one of only in the 90s. We were one of only like 5 or 6 mutual funds that could go short.
Which is
It was very unusual at the time. It was
it
way ahead of
is.
its time. Yeah.
Well, and even still in a mutual fund, legally, there's only a certain amount that you can go short.
25%.
Yep. And
Yeah,
it gets
you're
much
in
smaller, and then it's
yeah.
tink.
The reason behind that is actually 25, you're able to invest outside your strategy with up to 25% of your fund. And
The
that's how we went. That was our workaround.
well, and I want to say the 1940 Mutual Fund Act only allowed up to 10%. So when it was
Yeah.
initially built, I mean, so most funds were long only, and
Yeah.
nobody thought to go short. And that 10% usually was dedicated to cash or replicating futures. So if you had
Yeah.
extra capital and you needed to rebalance your mutual fund, you would do it using a futures contract. So there are more things on this slide. So let's see what we're going to do. So more and more people are starting to invest. We had collateral starting to fall. Counterparties began to get suspicious. So there is this
Yeah.
idea
That's
they're like,
you're politely saying front run.
yeah, they're
Yeah.
like, ooh, stuff is happening.
Hmm.
And then to what you said earlier, people started copying
Oh yeah.
what long-term capital. You can't invest this large of a size and not have the market see what you're doing.
Yeah. And I know because I worked at a hedge fund where we started a fund to fund so we could get insights into some other funds.
Yep.
I know that's what the investment banks were doing. They wanted to get a better idea of what LTCM was doing,
So they
so
could do it
they
themselves.
they, they invested with them.
Yep.
And that was another thing that eventually put them out of business.
Yep. So things are getting a little more strained for LTCM or long-term capital management. I think there's one more point. Could be wrong. Okay.
Oh yeah.
Yeah, copiers. Then copiers started developing arbitrage around anticipation, um, or they had relative trades. So if you
Mhm.
have a position with long-term capital management and you anticipate that LTCM is going to do something, you could replicate what it's doing. So you've created
Mhm.
a synthetic LTCM position. And since you already own it, you've now created the underlying in a synthetic position. And then you can arbit off of each other if
Mhm.
those prices are out of line, which is like,
Yeah.
right? Like to me, that's just amazing. So when you start to see these pricing misalignments, you know something's really going on.
Yeah.
So we have some issues happening with long-term capital management. People are aware, they're aware of the leverage, they're aware of what they're investing in. We
Hmm.
see that the oil prices are dropping, so we're going to see um, the price of the ruble go down, which is going to
Hmm.
crush their position.
Yeah, and beyond that, Russia got so broke they were defaulting on their debt.
Just crazy.
I know, I know.
So
Uh,
some of the takeaways
mhm.
from long-term capital management is we started to really start to rethink the way we appraise risk. Because, and the reason why we're going down this path of information is if we don't learn from these mistakes, what are we doomed to do?
Oh yeah, yeah.
We're
No,
just
exactly.
again.
Yeah.
Um, and again, this is the first time we really started to see some of this contagion really start to come out, and we didn't do anything about this. I mean,
Not really. It was a
built
band-aid.
right, they bailed out long-term capital management, but there was no real structures put in place like after 2008. So,
And their trading was over the counter. And a good portion of their trading was over the counter, or through swaps, et cetera. And that market continued to expand, and this is one of the things that led to the problems in 2008.
well, you got to
They
think there's
could, if
decade
they'd gotten
before
ahead of it at this
that.
time, it might have helped.
And then we didn't talk about the 1987 crash,
Mhm.
but number four is in for the 1987 crash, we had this over reliance on this quantitative strategy involving put options, and that helped because basically everybody was putting on the same strategy. And again, we've got now in long-term capital management a similar structure going on where people are relying on the same, and again, it's a quantitative strategy. Nobody's really jumping in and looking at these models. Nobody's really thinking, oh, maybe I should be getting out. Maybe we
Mhm.
should be stopping. So we really need to understand where some of the risk comes from. And this is particularly, you're a small fund for yourself and you've got
Mhm.
a handful of investors, this most likely won't apply to you because you're not large enough that your quantitative strategy is going to disrupt the market or
Yeah.
you don't have people copying it. But once you start to get to that size proportion, we start to struggle with that. I mean, it's one of the
Mhm.
reasons why we had the flash crash and things like that. So we see this again and again and again in the marketplace.
Oh, I'm trying to find that. There we are. Oh yeah.
Yeah, and
A
so
lot of them are marked.
what's
Yeah.
that?
No, I just that first bullet point. Yes, they were marked to market daily and it got ugly.
It
So go
was.
ahead. I
So
just
I'm going to ask you for our number one fan, what
Mhm.
is mark to market?
Well, that means let's say that you and I enter into we're going to enter into a swap based on the IU Miami game,
Okay.
the national championship. And basically the swap is you're going to pay me $100 if IU wins. I'm sticking you with Miami, and I'm going to pay you $100 if Miami wins. So, and we enter into that agreement right now. Uh, Today we're recording this on January 12th. The game's on January 19th. No money is exchanged right now.
Nope.
at all. Now, let's say Fernando Mendoza decide he's IU's quarterback. I'm assuming
Mhm.
everybody kind of knows that. Just won the Heisman. Let's say he pops up to a microphone one day and says, "I don't want to risk my NFL career. I'm not going to play in the championship game." That's not going to happen. That's not going to happen. But if it did, all of a sudden, the value of you getting paid if Miami wins is probably going to go up some,
Right.
and mine is going to go down, yeah, and IU is going to go down some. And if the risk parameters around that outcome change, mark to market means that I'd have to put some capital up if it looks like I'm going to have a loss. You would have to put a capital up if markets start to change and you're going to have a loss. So when things started to move against them very quickly, they had to write a big check.
And if you are leveraged up and all your capital's tied up in the trades, how much cash do you have available?
You have negative cash available,
Negative
and
cash.
basically you're going to have to get out of positions or raise cash.
Right.
And this is why, like, sometimes if there's a big event in one of the commodity markets, you'll see the stock market come under a bit of pressure. And that's because people may need to sell stocks to very quickly to raise cash because of a margin call, et cetera.
Right.
That's a different kind of contagion that bleeds through to, the rest of the marketplace. And I think LTCM was one of these examples.
Well, and they were so large. It
Yeah.
was just one of those, and again, it's so that's one contagion where you're looking at the different markets, but then we're going to also look at a flow diagram a little bit later.
Mhm.
Let's actually see where if that comes up next. Be
Not
curious.
yet. We
Oh
had
no, not yet.
all the
Not
bad things that were going on in
oh,
98.
yeah, yeah, yeah. Because again, these are important because
Mhm.
it's not LTCM didn't operate in its own little bubble.
Mhm.
But that contagion of different markets is different than contagion with borrowing from one. So let's say that I borrowed money from our number one fan to be able to get into this bet because I had to put up some money for the margin, right? But our
Mhm.
number one fan was dependent on you paying her for something. And if one of us gets into a pickle, then we all three start to go down. And so
Mhm.
that's a different type of contagion, which also occurred in this market crash.
Oh yeah.
So for your contagion, let's go back to the last slide.
Oh, sorry.
Right, but we start talking about no the 1998 stressors.
Just jumping all over the place. All right.
But we start to see that contagion that you're talking about. We
Mhm.
start to see it in corporate bonds. We start to see it in equities. We start to see it in bid-ask spreads being changed. Private sector securities, everything was
Yeah.
starting to get impacted. So I'm glad you brought up that type of contagion because we saw it in 1998.
Yeah.
And again, this is a type of contagion that happened in 2008. These are contagions that constantly will be happening. And our goal as economists is to learn from this and put up
Mhm.
safety so that they don't keep happening. So now let's look at our fund flow diagram.
There's our flow diagram.
So
Had a big old shock.
yeah. So this is a nice diagram of what starts to happen with that contagion. So we start to see those strains on the firm, whether it's writing that margin check, whether it's getting to your point about if you're borrowing at 4% and now you have to borrow at 4.25, 4.5,
Mhm.
4.75. Well, that makes your margin that much smaller if you're still making five, right? So we're starting to lose money on different types of ways. It can
Mhm.
also impact other markets, which then puts even more pressure. Deleveraging is when you start to sell out or unwind some of those trades. Well, once you start to unwind some of those trades, that impacts the other side of the trade, right? So we start to create this weird circular situation where it becomes a weird vicious cycle, and you can
Mhm.
really start to see the market contract.
So, and the one thing that I really and you and I have talked offline about this, but the liquidity thing is so difficult to explain to
Oh,
non-traders.
yeah.
But just a lot of people that trade, that show up, turn the machine on, and look for opportunities throughout the trading day. They get out of the way when we have excess volatility.
Yes,
And you know you can actually you know, I've seen it from working on a couple of exchange floors where people that are speculating for themselves on those floors, if you know if we've got a big employment number coming up in 3 minutes, they're not trading, they're out of the way.
yeah, I
And if there's a news item that we do not understand that is having a negative impact on their markets or creating excess volatility in their markets, you know, a good portion, a good three quarters, 80% of liquidity providers aren't required to trade every day. They don't have to. There are some that do, and they have some advantages on us, and they deserve those advantages because they got to be there on bad days like this. But the liquidity thing, if you start to see less and less liquidity in the marketplace, that's often a good indication that things are possibly topping out or there's something going on that we're not aware of because people aren't stepping up and taking positions in either direction.
Yeah. And so the liquidity is just the ease of being able to sell securities. So in this particular uh, instance, we had liquidity issues specifically around the Russian ruble, right? So the Russian ruble was losing value. Well, if it seems like it's plummeting and I'm looking to sell something because I need to get out of some trades so I can
Hmm.
pay my margin call and I'm start selling these at a lower and lower price, well, there's less people that are interested and willing to buy them from me.
Hmm.
So we run into that kind of liquidity issue.
Oh
Um,
yeah.
and I want to say something about I had a buddy who used to trade fixed income,
Hmm.
and he would say days that the treasury would come in and do something, is that it'd be like the big gorilla showed up at the sandbox.
Yeah.
And all you do is just get out of the way. You don't participate. You don't play with the big gorilla.
You
You
just
just get out of the way.
wait till they're done and then get back to work.
Right.
Yeah, I've seen that before. So, oh, exploding risk.
Yes.
Yeah.
So you've got now, it's the same idea, but now we're starting to see where it would show up in some of these risk metrics.
Hmm.
So where you're going to see it in the value of risk, where you're going to see it in the stress tests. You're also going to see if we were really digging deeper, we'd see this in the lack of stability in our correlation tables or covariance tables, right?
Hmm.
We would start to actually see a lot of these things. This is probably in your favorite area, the where we would see changes in VIX. We would see a lot of these metrics really change, and it's due to that vicious cycle that's been created.
Oh yeah.
So
So
results. And again, this doesn't, the deck doesn't put this in, but could you imagine being at that meeting uh,
no.
Sunday night before the morning close? And I want to say it was the Treasury Department who said, we don't fix this. We all go under the next morning. Like we
Yeah, I mean it
have to
was
figure out some solution.
and I think it was the first one of those. I
I think
really
it was
do.
um,
I think that was the
because
first time.
several of them happened in the early 2000s, and we were
Mhm.
just not privy to a lot of that information. But it was just the first time that, like, well, what are we going to do? Who's going to buy their assets? And in 2008, and we keep jumping around different crises, but in
Mhm.
2008, the government started buying some of those subprime
They
mortgage.
didn't they didn't do it here.
No, they did,
So,
but it's the idea of somebody has to buy these assets if they're going to
mhm.
make that margin call so that they can at least unwind
Mhm.
without pulling everybody down. And again, I
So
want to make the argument, no trader was hurt in the entire process. They still had their nice posh cars. They still
yeah,
sent their kids to very nice education.
their
Life
lifestyle didn't change very much.
there it did not.
Um, the one thing that I don't think, those of us that were in the business at the time that the book probably doesn't acknowledge as much as it should have is as the problems started to happen with LTCM, they had to open their books
Mm,
and everybody could see what their positions were. And everybody knew what they were going to have to get out of, and that actually made the situation worse for long-term capital.
sure.
Like XYZ firm knows that they're short. Let's just make it very simple here. Knows that they're short IBM or knows that they're long IBM, and the stock's coming under a ton of pressure. They may put a short position on it, knowing that at some point in the near future, long-term capital is going to have to sell that stock.
Sure.
And that makes the liquidity situation for long-term capital who's trying to get out of some of their positions even more difficult because people are trading in the same direction, but those trades were done by their investors to offset the losses. Kind of like you talked about, they basically had an arbitrage position that was similar to what long-term capital had on. They replicated their portfolio and made some money back by replicating their portfolio uh, when long-term capital had to liquidate everything.
And
So if you know somebody's got to sell something, you can
you can,
sell ahead of them and then maybe buy at a lower price.
and this is an important point, and I'm glad you used IBM as the example. Th- And this happened in the 2001 crisis because we looked at specific companies like Enron that went down. It becomes detrimental to the overall society because those who have invested in IBM for their
Hmm.
retirement account, if IBM is wiped out and loses 80% of their value, that's 80% of that person's retirement value.
Yeah, yeah.
And so we're, tongue in cheek joking around about these traders, and we're thinking about things from the, strategic way of how to manipulate the markets. But where it becomes a much bigger challenge is then acknowledging that this is somebody's retirement account and how does this impact the overall
Hmm.
society that we live in and operate in. And so I don't think some of those things were addressed very well in long-term capital management. I think they came back to haunt us in 2008 and subsequent
Yeah.
crises that we saw. But that's a real acknowledgement of their it's interesting strategy. It's interesting getting in there and doing the work and the
Hmm.
gaming, the gamification of the system. But again, these are individuals who need to retire, get
Yeah.
groceries.
Yeah. No, and you mentioned the meeting, and I just want to say something about it was Bear Stearns that chose not to
That's who it
help.
was. Right, 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 right.
And well, and that there's a common belief that everybody went after Bear Stearns in 2007, that just because they refused to play ball. And
Right.
I don't know if you've seen Wall Street 2. It's not as widely watched as the first Wall Street, but there's some side commentary in there about some firm being allowed to go under because they didn't play ball during the crisis.
Yep.
It was a direct reference to Bear Stearns. It
Yeah.
was, and that I'm not saying that everything was completely nefarious, but when things started to go poorly at Bear Stearns, they weren't getting any help from anyone and ended up getting bought out at pennies on the dollar. But did they end up part of JP Morgan or Bank of America? I can't.
They,
B of A is
I thought
Merrill
it was
and they're
JP.
JP Morgan. Yeah.
Yeah, I thought that was JP. And there was a comic that I saw about
Mhm.
it, but I being that anybody can watch this, I will not repeat it.
Uh-huh.
Um, yeah, there is definitely animosity towards Bear Stearns
Oh
from
yeah, there
all
must have.
that.
And Utah, and then finally, you were bringing up the this is part of your retirement. Unfortunately, and I know some people from Bear that, basically had to
Right.
recapitalize themselves. They strongly encouraged people to invest in the company's stock. And a lot of people, 80, 90% of their retirement was in the stock, and they got $2 a share for it.
Right.
Or 10, maybe 10 eventually. But it was really it was a very
I thought it was
disastrous
two.
situation. Well, I feel like they bid two, and then everybody had such a fit, they moved it to 10.
Okay.
That's kind of I feel like when they said two, they're like, "Are you kidding?" And part of
Yeah.
it was you got all these employees with the
And employees who had nothing to do with this.
Oh yeah, yeah,
And
that's
so, we
yeah,
talk about these large institutions. We're talking about a handful of people who are making these decisions and pulling the strings.
yeah,
We're not talking about the thousands of people who are employed by this company.
yeah,
Just
yeah.
like at JP Morgan, there's thousands upon thousands of employees who are working
Yeah.
there. They're not making decisions about what's happening in the trading desk.
Very few people that actually work at a big bank like that are actually traders. So
Right.
even if they claim they are. Oh,
Even if they
ne
claim they are.
next slide.
I was gonna say, oh,
Ooh,
more results.
yeah.
So this is just more about how we can monitor, how we have better practices.
Mhm.
I don't think we need to spend much time on that.
Nope. And then you're taking us home.
And we hope everybody has enjoyed this video. If you did, please hit like. And if you are not a subscriber, please hit subscribe. And with that, we look forward to seeing you next time. I think we might be moving on to the .com bubble because that's fun. And we hope to see you then. Thank you.